Today I want to show you how one principle, compound interest, can quietly build wealth over time, and how the time value of money changes the way you think about financial decisions. Imagine you have 1 million rand to invest today. You don't add anything, you don't touch it. 30 years later, it's worth more than 17 million rand. No trading, no side hustle, no luck, just time and compound interest. So let's break it down. First, simple interest. If you invest 1 million rand at 10% per year, you earn 100,000 rand each year. After 3 years, you would have earned 300,000 rand, and your total would be 1.3 million rand. Now take compound interest. In year 1, your 1 million grows to 1.1 million. In year 2, you get 10% on 1.1 million. That's 1.21 million. And in year 3, you get 10% on 1.21 million, and that's 1.331 million. After 3 years, you have 1.331 million, 31,000 rand more than simple interest. Now stretch that to 30 years. Simple interest would be 4 million, and compound interest would be 17.45 million. Same money, same rate, different outcome. That's compounding. Now, the time value of money. A rand today is worth more than a rand tomorrow. Why? Because you can invest it. Say you're offered 1 million rand now or 1.2 million rand in 5 years. At 10%, 1 million rand today becomes 1.61 million in 5 years. That's better than waiting. This is why money in hand now has more value than money promised later. Now, let's look at inflation. If inflation runs at 6%, 1 million rand today is worth only about 558,000 rand in 10 years. That means you need 1.79 million in 10 years to match 1 million rand today. Inflation silently eats your money. That's why you need to grow your assets to stay ahead. Here's a quick story. Joe and Mike are both 30 years old. Each of them has 1 million rand. Joe invests today and gets 10% annual growth. Mike waits 5 years, then invests his million rand. At age 60, Joe's investment is worth about 17.5 million rand. Mike's investment is worth about 10.8 million rand. That 5-year delay cost Mike 6.6 million rand. The cost of waiting is real. Now, let's compare investment choices. Let's say a money market account gives you 6% for 30 years and it turns your 1 million into 5.7 million rand. Let's say you can get in a balanced or high equity fund, you can get 10% for 30 years, and that million will grow to 17.5 million. That's a gap of nearly 12 million rand. Equities are volatile in the short term, but over decades they tend to outperform. If your goal is retirement or legacy, equities usually gives you the edge. And always reinvest your earnings. That's what makes compounding work. So what should you do today? Start now, even if it's with small amounts. Reinvest everything and use growth assets for long-term goals, and protect your returns with tax-efficient investment structures. The maths is simple. The mindset is what matters. Compound interest and the time value of money are tools. Tools that turn savings into wealth and your wealth into a legacy. Thanks for watching, and if this helped you think differently about money, share it with someone building their own wealth. And if you're ready to take action, start today. Your future self will thank you. See you next time.